Let's talk about Chapter 11. As always, make sure you read the big picture. It's right away on page 1 of Chapter 11, and they go through it right here. This is a continuation of what we did in Chapter 10. If you can recall from that chapter, that is where we had the beach cider, and then we had three people get together, Josh, Kyle, and Maria. Each had kind of different skills and different assets that they brought into the partnership, and they were we had the beach cider cafe that Maria owned. Josh owned the land, the building, and they brought in actually Kyle owned it, and they brought in Josh, who then helped develop a vacant lot. So 10 acres with 7 acres of land to be developed, and that was kind of the story. And then we kind of went through different variations of how they would go about forming that partnership and so on. And so we'll use them again, but remember that now this chapter is about distributions, transfer of interest, and terminations. So chapter 10 was forming partnerships. Chapter 11 is how do you distribute funds back to partners from the partnership itself. And then how do you transfer interest, basically one partner selling to another. How do you liquidate or terminate the partnership, or liquidate or terminate just one partner, but the partnership itself keeps going on. So that's kind of what's going on here. So they're going to give us here the scenario again. So we've got Josh, Kyle, and Maria. And now several years have passed since they formed their LLC. And then during that period, they've made significant distributions of cash and property to the members. The LLC interests and net underlying assets are currently valued at approximately $10 million, including a $1 million worth of goodwill on the cafe itself. The area has grown substantially. It appears to be a good time to develop the remaining 7 acres. However, it's going to be expensive, $15 million. Josh, remember, is kind of the real estate developer who kind of his skills were that what he contributed to the partnership and managing it and so on. And Kyle and Maria are nearing retirement age and would prefer to get out. So they want to dispose of the interests of the partnership, valued at $9.5 million, or 95% of the $10 million value of the LLC. And so they want to get out. Josh obviously wants to stay in and work on the expansion and figure that out and go from there and use his skills and his talents. Josh has been approached by a group of developers who are willing to invest $24.5 million necessary to make the improvements and to purchase Kyle and Maria's interests. Okay, so basically buy out Kyle and Maria. Josh would stay, and then the new people would essentially take over and then, of course, develop the property. So the transfer of Kyle and Maria's interest and the admission of the new members can be accomplished in two ways. First of all, the LLC could admit the new members for $24.5 million in cash, and then use $9.5 million left over to redeem the interests of Kyle and Maria. Or Kyle and Maria could sell their LLC interest directly to the new members for $9.5 million. The new members could then contribute the extra $15 million to the partnership to fund the expansion. And how are the distributions of cash and property to the LLC members treated? The expansion options have identical economic effects, but it could have different tax results. So that's really the big issue, is how Kyle and Maria want this done should be really kept in mind with what the tax results will be for them. So the questions that are, what are the tax consequences of admitting a new member to the LLC and redeeming Kyle and Maria out of it? And then what are the results that the new members acquire their interest directly from Kyle and Maria and contribute the cash or expansion to the LLC? So then we'll kind of obviously come back to this at some point as we go through the material. So distributions then return to the facts. Assume that Josh's basis in the interest in the beachside properties is $300,000, and the LLC will distribute $50,000 cash to Josh at the end of the year. Okay, so let's just go back to, he's got a basis of $300,000, and he's going to receive a $50,000 distribution. There is no gain in the distribution, and he reduces basis by the $50,000, so it goes down to $250,000. So just simply return on investment. There's no tax consequence to that. A payment. So let me, before we get into this, the first part of the chapter kind of has two big topics. The first one is just normal distributions. The second one then is liquidating distributions. So what we've got here is what they call distributions from a partnership, just a normal ongoing type of distribution. Okay, so a payment from a partnership to a partner is not necessarily treated as a distribution. It depends on what the payment's for. Partnership may be interest or rent to a partner, make guaranteed payment, or purchase a property from a partner. We talked about some of those in Chapter 10. If it's treated as a distribution, it will fall into one of two categories, liquidating or current non-liquidating. And it depends on whether the partner remains a partner in the partnership after the distribution. Okay, so liquidating distribution occurs when the partnership itself liquidates and distributes all of its property, or the ongoing partnership redeems interest of one of its partners, a partner retires. Okay, so basically the question is it will the partner still be a partner after the distribution, yes or no? A current or non-liquidating distribution is any other distribution from a continuing partnership to a continuing partner. Basically, it's not liquidating. Okay, and that's what this first part of the chapter is really covering. So current or liquidating distributions from a partnership may be either proportionate or disproportionate. Proportionate means the partner receives his or her share of ordinary income-producing assets. Disproportionate means the partner's share of certain ordinary income-producing assets increases or decreases. And most contributions in the chapter are proportionate. So all the homework problems that we're going to work through are proportionate. So that's going to be the most common one. That's really what we're going to focus on. So in general, neither the partner nor the partnership recognizes gain or loss on these. Partner usually takes a carryover basis and assets distributed. So whatever the basis in the partnership itself had in the property just simply transfers over to the partner that receives the property. And then the basis in the partnership interest is reduced by the cash and basis of property distributed. So it's typically pretty straightforward. Of course, there's always variations. The partner recognizes gain to the extent of cash received that exceeds the partner's adjusted basis in the partnership interest. Okay, so the cash has to exceed the basis for there to be a gain. Okay, reduction in partner share partnership debt is treated as distribution of cash. So we first reduce partner's basis in the partnership. Any reduction in excess of partner's basis in partnership results in taxable gain to the partner. Okay, so just FYI, and you cannot recognize a loss on a proportionate current distribution. That's one key thing to remember too, that bottom point. So in general, no gain are recognized on property distributions, whether the distribution is current or liquidating. Okay, generally. Okay, well, there's always adjustments to that. There's some ordering rules to keep in mind. When multiple assets are distributed from a partnership, they are deemed distributed in the following order. So cash is first, unrealized receivables and inventory, and then everything else. And the basis is allocated to assets within a category based on the adjusted basis of the partnership. So again, that means the basis in the partner, the base of the property, the partnership is what transfers over to the partner that receives the distribution. Okay. I'm going to skip all these examples. I go through a ton of examples in the homework. I've already recorded the homework portion. So there's a ton of examples there that I think are better than what they gave us in the PowerPoint. So I'm going to skip these, and that's the reason why. Now, in your chapter itself, there's also a ton of examples. On page 3, for example, there's examples 2, 3, and 4. Those are worth looking at. On page 4 of your chapter, there's examples 5, 6, and 7. Those are all worth looking at. And then the ordering rules are listed on page 5. So the ordering rules that we just got done looking at right there, those are on page 5 of your chapter. Okay, so I'm going to skip the examples just because I don't really care for them. I think they're confusing. I think it makes more sense just to use the examples from the back of the chapter. So that's what we're going to do. Okay, so that was distributions of an ongoing distribution. So basically, we're going to keep on trucking along. The partner is still a partner after the distribution is done. Now, before I get into the liquidating distributions, There's a really good summary on page 7 called Concept Summary 11.1, Proportionate Current Distributions General Rules. That's a good one-stop shop that explains the rules here. So when you're doing your homework problems, and the homework problem is about proportionate current distributions, page 7 would be the place to go and take a look. Okay, so just keep that in mind, page 7. Okay, now of course there's always exceptions. Okay, a gain is recognized if cash distributed exceeds the partner's basis. Then we have a gain. There's a few pre-contribution gain exceptions and disproportionate distributions. Okay, so there are exceptions. There always are, right? That's how this works. And losses are recognized only if assets received include only cash, unrealized receivables and inventory, and the outside basis exceeds the inside basis on distributed property. Okay. And again, I'm going to skip the examples here because we go through a ton of examples when we go through the homework at the back of the chapter. Okay. And again, they walk you through some really good, I mean, the rules are generally the same between proportionate, where the partner is still going to be the partner, and liquidating. So the rules are the same. So just keep that in mind. And again, but we have to take into account some of the side issues. And one of those first side issues is this one right here, the disguised sale. So this is a rule where the IRS obviously saw there to be abuses and realized, oh, we've got some abuses. We need to have some rules in place to prevent those from happening. So a contribution of appreciated property to a partnership followed by a cash distribution to the contributing partner may be treated as a disguised sale. Essentially, I sold it to the partnership and I didn't get, there's no gain because I sold, So keep in mind the IRS isn't like that. They're basically saying you just try to sell it and not have a gain, as opposed to when you just contribute it, there is no gain. So we're going to treat this as a sale of a property resulting in a gain. The cash deemed by the partnership for property, then partner's cash contributed back to the partnership, and then you have to record a gain. So just realize that's a no-no. If you do that, you can do that. You just got to pay a taxable gain on that. Marketable securities. Fair market value of marketable securities distributed to a partner is treated as cash distribution. Okay, so fair market value. So if marketable securities are distributed to a partner, that's the same as cash. Pre-contribution gain property. So contributing partner recognizes gain on distribution of pre-contribution gain property in two situations. There's a 7-year rule. In the homework, we're going to work through some examples of this. If the property is distributed to another partner within 7 years of the contribution date, the contributing partner recognizes the remaining pre-contribution gains. There's a 7-year rule here. The contributing partner's basis in partnership increases by the gain recognized, and the distributee partner's basis of property received increases by the gain recognized. Because again, we could be trying to hide a sale and avoid gain. So there's a 7-year rule about this. And again, the homework will have an example of that. Contributing partner recognizes gain on distribution of the pre-contribution gain property in two situations. If partnership distributes any property other than cash to a partner within 7 years after that partner contributes appreciated property, the contributing partner recognizes the lesser of remaining net pre-contribution gain or excess of fair market value distributed property over the basis of the partnership interest. So just a little bit about disproportionate distributions. It's very, very light in the homework. Occurs when partnership distributes cash or property to a partner which increases or decreases the partner's share of ordinary income producing assets, or what they call hot assets. Inventory and receivables would be your primary examples of hot assets. If the partner receives less than a proportionate share of hot assets and treated as if the partner distributed proportionate assets, The partner sold excess hot assets deemed in excess of actual back to partnership, and the partner recognizes ordinary income on sale of the hot assets. So one thing to keep in mind when hot assets are involved, quite often those are treated as ordinary income and not capital gain. But that's very, very common. So we'll come back to that in the homework problems. So hot assets include, inventory includes all assets other than cash, capital, and Section 1231 assets. And substantially appreciated means fair market value is greater than 120% of the adjusted basis, or unrealized receivables. Basically just receivables that are owed to us that have not yet been received. In the homework problems, they just focus primarily on inventory and unrealized receivables. But when you see those items, just recognize those as being hot assets. Okay. And then, of course, you can have a liquidating distribution where the partnership itself does not liquidate. Instead, we're essentially liquidating one partner out of the partnership, but the partnership itself keeps trucking along. Treated as distributive share partnership income or guaranteed payment to the partner. Certain items of the partnership is service provider and retiring partners or general partner. Okay. And then it says payments made or liquidated partnership assets. So it's kind of two parts. There's Section 736A and 736B. 736A is income, 736B is property. 736A payment to a partner has ordinary income or distributive share of income, and the partnership has a guaranteed payment if deemed without regard to partnership profits, and distributive share if based on profits. And then property payment if distribution is made in cash, and we might have some disproportionate distributions to extent of the share of hot assets, and potentially return on basis and capital gain or loss after that. So in that situation, there may be some capital gain or losses. So that's where in liquidating out a partner, there may be some capital gains or losses. So just FYI. So coming back to the big picture then, and recall beachside properties, assume that they decide to admit new partners for $24.5 million, and then use the $9.5 million of cash to redeem Kyle and Maria, and the extra 15 then is used to develop the remaining 7 acres of the property. Because the LLC itself is not liquidating, they call this a Section 736 liquidation. They show us then, with that in mind, the current balance sheets of the LLC, the basis column, and then the fair market value column. Remember that this has a lot of land and buildings, so therefore its fair market value is very, very different than the basis because you've got some land and buildings, especially in an area that's growing and property values are going up tremendously. And capital is a material income producing factor for the beachsider, because remember it's mostly land and building is the vast majority of their assets. So for Kyle and Maria, the entire $9.5 million is a Section 736B payment. Basically, it's in payment for interest in the property of the partnership. And so because of that, because it's 736B, they will recognize gain to the extent this distribution, which also includes forgiveness of any debt, exceeds their basis. And it's safe to say that because the fair market value of the property is so much higher than their basis that they would then have some capital gain on this. So it's 736B because this is a income producing factor. The capital is an income producing factor for the property. And they receive cash in lieu of shares of the LLC's unrealized receivables and inventory. It's also a disproportionate distribution. So they recognize ordinary income to the extent that their gain relates to these receivables and inventory, and then the remainder would be capital gain. Okay, so some of it's ordinary, not much, but some, and that and the rest is capital gain. So in general, when it comes to the sale of a partnership interest, generally results in gain or loss recognition by the selling partner. So now just think, and actually before I get to that, let me stop here and mention something in the chapter itself. I want to make sure that I cover, just like we had the summary of distributions. Page 10 is Concept Summary 11.2, Proportionate Liquidating Distribution when the partnership also liquidates. Okay, that's a good summary for when you get liquidating distribution questions. And then on page 16 is what happens when you have a liquidation of a partner, but the partnership itself continues, just like what happened to Kyle and Maria. Their partnership interests were liquidated, but the Beachsider still keeps on trucking along. So just a summary of some of that information that we just got done talking about in the big picture example is on the bottom of page 16. Okay, so I want to make sure I covered that with you. And then we're going to now have the new example of the sale of a partnership interest. There's a good summary of this one on page 21. So in this example, just think an existing partner is selling to a new partner. Okay, just somebody else. So Kyle or Maria could sell to somebody else their interest in the partnership. Generally results in a gain or loss by the selling partner. So a gain or loss is the amount realized less the basis in the interest, and partnership liabilities assumed by the purchasing partner treated as a part of the consideration paid. And we'll work through an example of this one too in the homework. It's a really good example. Partnership tax year closes for selling partner on the sale date. So whatever the tax year is becomes basically the sale date. And then hot assets include, again, unrealized receivables and inventory. And remember that those are treated as ordinary income and not capital gain. That's what it says right here. We must allocate sales price of hot assets as ordinary income, and everything else would go to a capital gain. And remember, that's important because ordinary income, the rate will generally be higher than the capital gain tax rate. So let's come back to the Beachsider and remember that we can kind of change it up now. And so one of the options would be for Kyle and Maria to sell their interest directly to these new people, these new investors. So they could do it that way. Okay, so they could each sell their half, valued at $4.75 million each to these new people. And then when these new people buy out their interests, they could then contribute the remaining $15 million needed for expansion. So still spending the same amount of money. It's just how they go about getting there is a little bit different. So Kyle and Maria would each receive cash total of $9.5 million plus relief on their debt. So going back to the balance sheet from a few screens ago, there was some debt that they'll get relief on that. And their basis in the LLC interest equals their capital account plus their shares of LLC's liabilities. And the difference is gain. The gain's ordinary income to the extent that it relates to Kyle and Maria's shares of account receivable, inventory, and depreciation recapture. Everything else is capital gain. And then there's a Section 754 election which deals with that depreciation recapture that they'll talk about in a little bit. So then other distributions of partnership interests, transfer of a partnership interest to a controlled corporation, tax-free if Section 351 requirements are met. And remember that we talked about Section 351 when we talked about contributions to corporations. I think that was like back in chapters 5 and 6. Or we can incorporate a partnership. So remember, a partnership can turn into a corporation if the owners determine that's a better vehicle for whatever reason to raise capital, reduce tax rate, whatever that would be. They can certainly go that way too. There's a few methods to do that. Transfer each partner's interest in exchange for stock would be one method. Transfer partnership assets to a corporation in exchange for stock. An assumption of partnership liabilities would be one. And then the partnership distributes all assets and liabilities pro rata to partners in complete liquidation of the partnership. So there's really not a ton of homework about that. Just a little bit here and there about that. Incorporating a partnership, again, all three methods of incorporating are tax-free, with the exception if liabilities of partnership exceed the basis of transferred assets. And this kind of goes back to some of the Chapter 5 and 6 stuff when we formed and distributed corporations. Non-taxable like-kind exchange rules do not apply to the exchange of interest in different partnerships. Those exchanges are fully taxable. And generally, if the gift of partnership interest is tax-free, and we have a little bit of a question about that one that we'll work on. And then what happens if there's a death of a partner? Taxable year of partnership closes with respect to that partner on date of death. Compute deceased partner share partnership income or loss to that date of death. Report on the final 1040. The interest will later be sold from the estate to another party or redeemed by partnership as discussed earlier. So you can redeem that partner share. Okay, so 754. Adjust partnership bases and assets to reflect gain or loss recognized by a partner receiving a distribution from the partnership. The adjustment affects the base of partnership property with respect to all partners remaining in the partnership. The difference is the amount paid by the purchasing partner and partner share of the inside basis, and the adjustment affects the basis of property, a partnership property with respect to the transferee partner only. So once made, the election applies to all future years unless election revoked with IRS consent. Okay. So coming back to the big picture example, we're going to for the either restructuring option, each side could take a 754 election and reflect an adjustment to the basis of the property and do what they call a step-up basis. So on a sale of interest to the new members, the step-up would equal the difference between the $9.5 million paid to Kyle and Maria's share and the step-up of approximately $7.6 million, which is $9.5 million minus 95% times $2 million net assets, would be allocated to various properties, and then deductions related to the step-up, such as depreciation, would be allocated to the new developer group. So they can do this if they want. They don't have to. Step-up related to distribution, liquidation, LLC members' interests. If the LLC redeems the interest of Kyle and Maria, the LLC can step up the basis of its remaining assets by the amount of gain recognized by Kyle and Maria. The step-up is about $7.8 million. And they can do it if they want to. They don't have to, but they can. Okay. And then termination. Termination happens when no part of the business continues to be carried on by any partners. The partnership terminates and its tax year closes when the partnership incorporates. One partner in a two-way partnership buys out the other. A termination also occurs when the partnership ceases operations and liquidates. And the partnership tax year usually does not close upon death of a partner, entry of a new partner, liquidation of partner's interest in other than a two-party partnership, or upon sale or exchange of existing partnership interest. Coming back to the big picture, return to the facts of the big picture. Before the sale or redemption, Kyle and Maria's combined interest equaled 95% of the capital and 80% of the profits interest, because Josh got 20% due to his management ability, so he got 20% of profits. Whether the interest is sold to the new developer group or B-side redeems the interest of the partnership continues in existence after the transaction. And family partnerships, owned and controlled primarily by members of the same family, often done to save taxes by funneling some of the parents' income to children. Often difficult to establish for tax purposes. Family members will recognize as a partner if capital is a material income producing factor and partnership interest is acquired in a bona fide transaction where ownership and control are received, and capital is not a material income producing factor, but family member contributes substantial for vital services or vital services. Kiddie tax may apply to child partner under age 19 or a student under age 24 and claimed as a dependent by a parent partner. And then limited liability companies, remember that LLCs with 2 or more owners is taxed as a partnership. So for the IRS, they basically just say that's a partnership. And then limited liability partnerships, kind of the same deal too. And really the only difference between an LLP and an LLC is that under an LLP, members of an LLP are not liable for, let's say, malpractice or torts committed by other partners. So think quite often that'd be doctors, lawyers, accounting firms. So if one practicing doctor, lawyer, accountant did something really bad in terms of poor services, there was malpractice, only that person is liable, not the other partner. So that's the one main difference between an LLP and an LLC. Now for the new Beachsider, 2 things are happening when the new developers become members of Beachside. They're buying out the interests of 2 existing members, and they're providing cash to expand the operations. The expansion itself raises no specific tax problems. An LLC can admit new members with no immediate tax consequences. In addition to the issues addressed earlier in the chapter, the LLC operating agreement should be modified to ensure there's no shift in ownership rights between Josh and the new members. So you need to just look back at the agreement, make sure that everybody's on the same page in terms of capital and income sharing. What if, assume the developers have only $5 million in cash with good prospects of receiving an additional $10 million over the next 2 years and $9.5 million more in the 3rd year. The LLC found a bridge loan and temporary financing of $12 million to cover costs during the interim period. So basically they feel pretty good about receiving future financing and they borrow some money. So what if this loan is not large enough to also completely buy out Kyle and Maria? They've agreed to accept installment payments, basically as new investors come in down the road. Now the buyout can be treated as either installment sale or redemption, requiring a series of payments. So under section 736. Okay, so there would be different tax consequences than if that happened, basically. Okay, so that's it. Really, the 2 main topics in my book, and the main topics that you'll see homework problems on, are distributions to a partner who's still a partner after the distribution, and distributions to partners that are then liquidating. Okay, those are the big 2. And then there's a little bit more about what happens when one partner sells out to an outside third party. And there's a little bit about, in your homework, about, the family-owned relationship was there too. So, but the big 2 are the distributions and how you handle those and so on. So if you can get a good handle on those, I think you'll be in really good shape. And those little summaries that I mentioned earlier, really, I would say if you have those in front of you, when you're doing your homework, I think that will be the key. That will really help you do well with the homework and go from there. So as always, if you've got questions, just let me know. But it's also important to read the chapter too and look through the examples provided in the chapter. Those are all really, really good, and they'll help you quite a bit as you work on the homework.